Welcome everyone to the GSG webinar on the Impact Weighted Accounts Initiative. I'm really looking forward to the discussion today. It's really wonderful to have a large and really diverse audience. We're expecting over 850 people from across the world to be joining us, and we can see the numbers increasing quickly. So welcome again to everyone who has just joined. This is a live webinar, so your comments and questions will be read and integrated into the discussion. We will use polls to get your thoughts on the topic as the discussion evolves. This promises to be a very exciting and vibrant discussion, covering one of the key tools we at the GSG believe to be needed for a just and impact-led recovery. We at the GSG aim to catalyze a global ecosystem for impact investment as a key enabler of innovation, entrepreneurship, and capital to deliver impact at scale. For those of you that don't know, we work with countries represented by their national advisory boards, strategic partners, and other key stakeholders to identify priorities, deliver initiatives, raise awareness, and advocate for the development of impact investing around the world. We currently work with 28 national advisory boards, covering 33 countries across our 5 continents. You can see on the screen now. Earlier this year, we kicked off a number of projects supporting a just and impact-led recovery. Here you can see all the 6 projects we are currently working on. This one sits under the impact accounting and reporting. So this webinar today is specifically targeted to corporates and investors to explain the Impact Weighted Accounts Initiative. This is part of a project where the GSG and the Impact Weighted Accounts Initiative are working on joint stakeholder engagement. Following this webinar, we're offering 3 roundtable sessions for a deep dive on this topic for corporates and investors in November. So please express your interest in joining these sessions. The link will be in the chat box shortly. So when you all signed up for the webinar, we asked you how familiar you were with the Impact Weighted Accounts Initiative. So I think my colleague Laura will be bringing up a slide with that shortly. Perfect, thank you, Laura. So a lot of you are already somewhat familiar with the topic, and some of you are already very familiar with the topic. So for those of you that are not so familiar, the Impact Weighted Accounts Initiative is aiming to drive the creation of financial accounts that reflect a company's financial as well as social and environmental performance. The goal is to create accounting statements that transparently capture external impacts in a way that drives investor and managerial decision making. So just before we get started, I wanted to bring up a poll. So just to get a little bit of understanding as to what your understanding is of this so far. So the Impact Weighted Accounts Initiative has done some analysis of Apple. What sort of impact would you expect Apple to have had through its employment in 2018? Now, the options available are mostly negative impact, mostly positive impact, or roughly equal. You could just go ahead and fill in that poll, and then we'll have a look at the results. Okay, Laura, if you could show us the results as they stand. Okay, great. So roughly equal positive and negative impact so far. So the answer to that question is that, according to George and his team, Apple have had a positive impact through their employment. So, and that was worth about $8 billion in 2018, which is 25% of its earnings. So just quickly, the next poll we'll bring up is along the similar vein, and it's what do you think was a negative environmental impact of Nestlé's operations in 2018? The options there are none. Nestlé did not have any negative environmental impact, or $160 million, 1.6 billion, or 16 billion. So it'd be really interesting to see how you in the audience, what environmental impact you think Nestle had in 2018. So please go ahead and fill in that poll now. Great, thank you very much, Laura. So it seems like a lot of you have got the answer right. That was mentioned in the Harvard Business Review article that was sent out yesterday. So perhaps there was some pre-reading done there, but that's right, exactly. So according to this work, Nestle created $1.6 billion worth of negative environmental impact in 2018, and it's actually one of the food production companies with the lowest environmental impact as a percentage of earnings. So let me introduce the speakers today. So we have 3 speakers. We have Sir Ronald Cohen, George Serafeim, and Quyen Tran. I will introduce them all in turn, and then we'll have some Q&A, followed by a lot of audience questions. So please fill in the chat box with your questions or put it in the Q&A box. And even if you don't have a question yourself, you can upvote others' questions. So please, we're going to be doing a lot of polls and audience interaction throughout this webinar. So please let us know your thoughts. So I'll start with Quyen. Quyen Tran is the Director of Impact Investing for BlackRock. Her research and publications create the structural narratives for advancing impact investing in public equities, including the case for impact in public equities, the case for alpha, and best practices in impact measurement. She's a member of Harvard Business School's Alumni for Impact Initiative, serves on the GINS Working Group for Impact in Public Equities, and is the board advisor for Bentley's University Sustainable Investment Group. And we've got George Serafeim, who's a Charles M. Williams Professor of Business Administration at Harvard Business School and the chair of the Impact Weighted Accounts Project at Harvard, and is internationally recognized as an authority on ESG investing. And then we've got Sir Ronald Cohen, the chairman of the GSG, the Impact Weighted Accounts Initiative, and Portland Trust. He's a co-founder of Social Finance UK, USA, and Israel, co-founder, chair of Bridges Fund Management and Big Society Capital, and co-founder and was exec chairman of APAC Partners. He is also the author of a recently published book, Impact: Reshaping Capitalism to Drive Real Change, which shows how impact investment can and already is shaping our economic system. So, Ronnie, over to you. Over your long career, you have seen a number of changes in the financial markets, as well as in the impact space. What does the Impact Weighted Accounts Initiative aim to do, and why is it important now?
Wonderful, Francesca. Well, thank you very much for joining us, all of you. It's wonderful to be here with Quyen and with George to exchange views with you about what I consider to be a defining change in both our financial and our economic system, and one which hopefully can bring great improvement to society and the environment. Well, Francesca, as you mentioned, I've had a very long career. I started in 1972 at the age of 26 to co-found what became Apex Partners. And at that time, a massive new change was occurring. The change that was occurring, which made venture capital and private equity possible, was a change in investment thinking that stemmed from the measurement of risk. Most people, Francesca, don't realize that it's only in the 50s that academics of the University of Chicago began to contemplate how we could measure risk. Of course, investors had been aware of risk for hundreds of years, and they thought about it when they made their investment decisions. But the decisions were made basically on the basis of measurable financial returns. With the 1950s came the idea that you could measure risk by looking at how much stocks and shares and bonds moved up and down over the long history, and that this would enable you to infer their future volatility. And that transformed our whole investment world. At the time when I kicked off, at the time before I kicked off, by 1972, it was just beginning to change. Every investment portfolio held the two securities, basically, the shares of the local stock market and the bonds of that stock market. And with the concept of measurable risk came the concept of risk-adjusted returns. That brought the idea of diversification. This idea of diversification opened the door to multi-asset class portfolios, where venture capital and private equity and emerging markets could find their place, because although they were considered to be more risky, they delivered more than proportionate returns. And so you could say that the new thinking around the measurement of risk and the concepts that it engendered led to the funding of the tech revolution and globalization. And then when we saw that rotation begin to gather momentum, we began to have another major change in our investment portfolios and in our world. It was the arrival of the tech revolution. And initially, people were skeptical that tech would really change anything. And today, as we look back, we realize that all those who thought that tech would not have much influence have actually been left behind. And we've seen brand new startups in the space of 20 or 25 years overtake century-old companies which had dominated their sector. So we saw Apple and we saw Microsoft overtake IBM as an example. And impact-weighted accounts and the impact transparency that comes from measuring impact and translating it in financial terms into financial accounts, so that when we analyze the financial accounts of a company, we can gauge both its financial performance and its impact performance, is going to engender an equally tectonic shift in portfolios. Already, the information that George and the team, the brilliant team that he has assembled at Harvard Business School, show us through the 1,800 companies whose environmental impact has now been put on the web, basically, can be accessed by everyone on this call through the Harvard Business School website, just by looking at IWA, impact-weighted accounts, shows that there is a correlation already apparent within several sectors between lower environmental damage and higher stock market valuations. So the $30 trillion of ESG money that is already flowing to achieve impact as well as profit is tilting the scales. And when George speaks, he will talk about the employment impact that we're now beginning to reveal, because we are basically putting down the way of arriving at generally accepted impact principles and then implementing these principles through the metrics that long-standing efforts like those of SASB and GRI and the GIN and B-Lab and others have managed to assemble. We're taking those metrics and we are monetizing them. And so we will add to the environmental impact, the employment impact, and very soon we will add to the employment impact, the product impact, giving us total transparency on the impact that companies create and the ability to measure their impact performance. So it is going to lead to a rotation of our portfolios, which is already apparent in the numbers that I was referring to, away from impact negative companies to impact positive companies. And I believe it will prove that optimizing risk return impact actually delivers better returns than just optimizing risk return. And so we can begin to anticipate that impact transparency, when it gets mandated by governments so that we have audited numbers from companies to work with rather than just numbers that they have made public, which have not been audited, we can see how the mandating, which will come within the next 3 or perhaps 5 years, it'll be no longer than that, Francesca, is going to change the behavior of companies. So happy to go into greater detail, but I think it is one of the tectonic changes that I have seen in my career, and I think it has huge implications for the improvement of our society and our planet.
Thank you, Ronnie. Thank you for giving us that perspective and a little bit of a taste as to what the Impact Weighted Initiative is doing. I'd like to turn to George now to hear a little bit more about the details. So as a renowned accounting professor at Harvard Business School and as a global expert on ESG issues, could you tell us a little bit about how you think this could change how accounting works, who is already using it, and what interest you've received over the last few months?
Thank you very much, Francesca, and thank you very much for highlighting this whole work. And Ronnie put it very well about the transformation that we're experiencing already and that we will be experiencing in the next few years. And I think in order to be able to put impact at the core of the economic system, not at the periphery, not as an afterthought, but actually the way that the system is creating value and is distributing value, that needs to be reflected in how we define success in society. And right now, the way that we define success in society is by having an accounting system that completely ignores any effects on employees, on customers, and on the environment as well. Many people ask me about whether for example, when we are actually trying to value some of those effects, whether we have the right price and whether we have the right estimates. And the way that I respond is that perhaps we do, but what I know for sure is that what we're doing right now is exactly the wrong thing, which is basically we're assuming that the value of all of those impacts is zero because they're not reflecting anywhere actually in the financial statements. And when they are reflecting, they're creating disincentives, for example, to minimize the value of labor in society because they're actually employee expenditures are accounting only as an expense in the income statement. And as a result, we're having a management paradigm that treats all of those expenses as just a cost item, not as something that needs to be grown in an organization in order to be competitive, not as a labor that needs to be respected and actually needs to have strong employment practices, good wages, a sense of inclusion in the workforce, but that's something that needs to be minimized in the system. This is what we're talking about redefining what is success in business, what is the definition of profit, and what is the definition of value. And fundamentally, that's why we're working around those three pillars: environmental impact, employment impact, and product impact, because those represent, one, the impacts that you're having on the environment from your operations, second, the types of impacts that you're having on your employees, and third, the types of impacts that you're having on customers and local communities from your products. And Ronnie mentioned a couple of things that are important. One is that we have already been able to document that once you can measure environmental impact, you find a pretty strong correlation between that environmental impact after accounting for other factors, such as, for example, profitability of the firm, size of the firm, capital structure, and so forth, and the market multiples that you observe in capital markets. So what this means is that for several industries, with transparency comes actually accountability. And this is a very, very important message, and that many of those impacts are actually decision relevant information for business decision makers. For example, you observe in the constructions industry, in the building products, in pharmaceuticals, in electronic equipment, and you're finding that organizations that have a higher environmental intensity and higher environmental negative impact are actually trading at lower valuation multiples compared to their competitors within the same industry. But at the same time, in other industries, we don't find any of those effects. And that is the case, for example, in some of the most high carbon and high polluting industries, such as the utilities, where we don't find any effect. And I think this is a lack of transparency that exists in the markets and lack of innovation that exists in many of those industries. So with accountability actually comes innovation as well. And this is what we're trying to create. At the same time, Ronnie also mentioned about some of the employment impacts. And for me, it was fascinating in your polls, Francesca, that so many people got exactly right the environmental impact that is coming from Nestle. And for me, this is a fascinating effect because this is the learning that is happening in markets. Once you can actually put some numbers out, we have all agree about those numbers and then how that learning is happening. While, for example, we saw much more disagreement when we asked about the employment impact around Apple. And this is partly because that was publicly released just a few days ago. So I'm sure if we do that poll a month from now, we'll get very different effects. This is the power. This is the power of measurement. This is the power of actually creating a learning society where we can use rigorous processes to measure different impacts. We can disseminate that, and over time, the accounting system to be reflecting those impacts so we can create a more equitable and a more sustainable society over time. And in terms of the question, Francesca, around market adoption, I think this is a fascinating question. The reason for that is when we started this journey just a year ago, because I want to remind everyone, this has been only 12 months. This is a fascinating journey, and a lot has been accomplished in just 12 months. We took stock of the market and we said, what is happening in terms of impact valuation, impact weighted accounting? And we found 56 organizations internationally that were doing some form of impact weighted accounting. Most of it was around environmental, not surprisingly. A little bit was about employment, and even less was about product impact. And what we're finding now is this exponential growth in organizations that are experimenting with impact weighted accounting. And this is an invitation as well for everybody to join us in that, I would say, piloting process, learning process, and innovation process, through which both organizations, corporations, but also investors are actually finding value in the data. They are finding value in the impact measurements and the information that allows them at the end of the day to make better decisions. For me, a lot of the impact is actually providing you information both about risk, but also about growth opportunities as you are creating new markets and new products. We are experiencing a large-scale transformation in how markets work. Why so many of the transitional investment strategies no longer work? Because the world has changed. The world is a much more transparent place, and something that can have a positive impact or negative impact. Now, under the right structure, under the right information structure in society, it can be internalized, that impact, and actually affect market prices and affect the competitiveness of organizations. So as a result, we need a better accounting system. We deserve a better accounting system. We created the capital markets that we have today because we invested in society over the last 100 years to create the financial accounting framework that we have today. Now is the time to invest and create the impact accounting system in order to create large-scale impact investment markets. And the last thing that I will say, Francesca, before I open up for other questions or to transfer to Quyen, is that we're not going to get it perfectly right from the beginning. Why? Because financial accounting system doesn't get perfectly right. We're going to keep improving. We're going to keep building. And what we need to fundamentally do is keep making progress and actually expanding the scope of accounting. What has been happening in the last 100 years is that the scope of accounting has been very narrow, just looking at the financial impacts and just measuring manufactured, physical, and financial capital. Now is the time to actually measure systematically the social capital, the human capital, and the effects on the natural capital that we're having. And this is exactly what we're doing.
Thank you very much, George. Thank you for that perspective. So I'm seeing questions come in from the audience in the Q&A and on the chat box, and I'm seeing an interesting one around, how does IWAI fit in with other initiatives in the market? So what we're actually going to do is we're going to do a little short poll, which we're going to bring up now, because there's a lot of confusion in the market about what is often referred to as the alphabet soup of standard setters. So I'm just going to ask you here as the audience, are you familiar with any of these acronyms? And please pick as many as you are familiar with. We've got the IMP, TCFD, SASB, GRI, which you already referred to, George, and you as well, Ronnie, and the IRC. So please, could you just take as many as you're familiar with, and then we can explain a little bit more about how the Impact Weighted Accounts initiative fits alongside these. Great. Okay, so a lot of you have heard about GRI and a few less about the International Integrated Reporting Council, but actually a lot of you have heard of at least one of these, and most of you have heard about all of them. So we know that there's some confusion in the market, and I think it's interesting just to address this question now, seeing as it's also come up in the Q&A box. George, could you address this point about how IWAI works alongside other initiatives in the market, and then we'll move on to Quyen and then open up to questions.
Absolutely, Francesca. And by the way, the work that many of those organizations have done is incredibly important, actually. I remember my friend Alan White, actually, who was the co-founder of the Global Reporting Initiative. And something that told to me initially is when he set up the Global Reporting Initiative, he said there was no transparency. There was no accountability process for stakeholders. So shareholders had quite a bit of information, but for stakeholders, there was very little accountability. And I think something that we have learned over the last few decades is that the well-known what gets measured gets managed might be true sometimes, but in many ways it's not. And actually what we have found is that what gets managed gets disclosed, not necessarily gets managed or gets the outcomes that you need. And I think this is a very, very important lesson. And I think in our theory of change is that impact needs to be at the core of the economic system. You cannot have some measurements that are outside, for example, the way that we define success in society. They need to be valued, those impacts, and they need to be reflected in the financial statements. So the way that I describe it is that many of those organizations are doing incredible work. And actually we rely a lot on their work because we need that transparency. We need the metrics that are coming from these organizations in order to do the valuation. And the valuation part gets you to the monetary estimates. Once you get to actually the monetary estimates, then this is something that can be reflected in the financial statements, in the income statement, on the balance sheets. So the way to think about it is from a value chain perspective. We are actually using many of the metrics that are coming from SASB and the GRI to apply to our framework to get at the valuation part that then allows you to reflect in the financial statements. And I think this is the next iteration. I teach a course that's called Reimagining Capitalism. Reimagining and reshaping capitalism cannot happen if we have impact as an afterthought of the economic system. We cannot have a reshape of capitalism if this is something that is in the periphery of how business is doing its work. It needs to be at the core of how you create value. And as a result, it needs to be something that affects how you define profits, how do you define assets, how do you define liabilities. And once you can bring it to the core, then you can actually have policy making, you can have regulators that use those numbers to create incentives, disincentives, and taxation system that doesn't tax all of us for the negative externalities, for example, that companies might be creating, but actually taxes directly the companies that might be creating those negative externalities. In the same way that can create incentives for the creation of positive impacts in society. So I think that's where we are, and we're resting in many ways on the shoulders of very, very important organizations, many of which you have just outlined.
Thank you, George. I'd like to bring Quyen now into the discussion. Quyen, you are here today representing BlackRock, the world's largest asset manager with over $7 trillion under management, and one that has been in the spotlight in the sustainable and impact investment community for a few years now, especially given Larry Fink's letter to shareholders over the last 2 years. What do you see as the potential for the impact-weighted accounts initiative for BlackRock?
Thanks so much, Francesca. Yes, so I see significant potential for the application of the impact-weighted accounts at BlackRock. In terms of the possibilities, there's primarily 2 complementary pathways that we're exploring. The first is a broad application, and the second is more specific. So from an investment stewardship perspective on the first application, at BlackRock, we always seek new investment tools and research that can help us evaluate the impact of a company's stewardship practices. And this includes environmental impact from a company's operations. It includes the social impact from its treatment of employees and so forth. And yes, there's an abundance. There's arguably too much information that's to be digestible from an ESG perspective. There's ESG ratings, there's scores, there are reports, there's analytics, but there's no methodology that we have seen that allows investors to evaluate impact of these issues upfront, either in the financial accounting statements themselves or in financial accounting terms. So this would quantify and monetize impact in such terms. So the impact-weighted accounts methodology, the frameworks, the templates, the tools, this should increase the comparability and the scalability of impact analysis, which I think is critical if we were to drive wide adoption and alongside that, more enduring, lasting impact. So if we look at the perspective from an investor, so you can imagine there's differentiated insights that an investor can develop by triangulating 3 lenses. So the first is our traditional financial analysis, fundamental analysis. The second lens is from a stewardship perspective, a holistic evaluation of a company's operations and impact thereof. And the third is the lens from the impact-weighted accounts framework. So we're beta testing and combining these 3 complementary lenses, which should allow us to more accurately assess a company's underlying impact, its fundamental value. And so the impact-weighted accounts has a very attractive value proposition. At BlackRock, in addition to beta testing this broad application of the impact-weighted accounts, there's also a very specific application that we will be piloting, working with George, Rob, and the impact-weighted accounts team. And this is really exciting. This is the impact-weighted accounts product impact framework and templates, industry by industry. So at BlackRock, we've launched a non-concessionary impact investing strategy in public equities, where we invest only in companies whose core products and services help solve the world's great social and environmental problems. And there's tremendous need, and in fact, even more so today, given our pandemic, for affordable housing in every country, the need for access to education, access to basic healthcare, the list goes on. And so we have our methodology for quantifying and qualifying a company as impact, but what we see as complementary to this is the impact-weighted accounts methodology. And so in addition to these product-specific templates, in the specific application, we will be evaluating the broader application. So holistically, these are very complementary and very exciting. In terms of the scalability and the differentiated proposition of the impact-weighted accounts, what we see is that this methodology and this framework, these tools, can make a real difference and advance not only our work at BlackRock, but also that of the broader impact and sustainable investment industry. And I think these are critical next steps that will be exciting to see.
Thank you very much, Quyen. It's so valuable to hear your perspective on this work, and look forward to hearing how it evolves. So I think we've got a lot of audience questions. We've got a lot in the chat box, a lot in the Q&A box. So I think I would suggest we just move over straight to the audience questions, and Rob will be moderating this part. So Rob is the program director and senior researcher for multi-faculty sustainability and impact investing special projects, including the Impact Weighted Accounts project. So Rob, thank you for moderating this part. Please switch your video on so that the attendees can see you, and over to you.
Wonderful. Thank you again for all of your comments. Thank you to the audience for the huge number of questions that we've gotten. It's always great to see people engaged in it. So the first question, I'm going to go back to Ronnie to say, to sort of understand, there's a question of how we convince governments, many of whom operate in a zero-sum game mentally, to mandate inclusion of impact within their financial statements when that may actually then affect or reduce their tax base in a way. Have you heard this in your conversations at all, or?
Yes, I certainly think that there is a link between impact transparency and taxation, as George explained. But Rob, perhaps I can address the first part of the question and then the second. The first part of the question is, how do we get governments engaged in this? And I've come to the view that it's inevitable that they will have to. Why? Because the Harvard data, which you've contributed to preparing, has already shown that impact information is price sensitive. And so the more this information is disseminated and used by all of us, the greater the need of government is going to be through its regulators to maintain an orderly market where all investors have access to the same information. Now, this is what happened after 1929. After the great crash of 1929, at a time when every company picked its own accounting principles and there were no auditors, as you well know, investors began to realize they didn't have sufficient transparency on the profitability of companies. And only 4 years after the crash in 1933, because big crises often create the background for big steps forward, the US led the world in bringing generally accepted accounting principles and the use of auditors. Now, at the time, Rob, again, as you well know, many people remonstrated that this was an impossibility. How could you pick a single set of accounting principles and apply them to every company, irrespective of its size or its sector? And that if it did succeed, it would spell the end of American capitalism as we know it. And of course, we know that that transparency has been the foundation of the huge global financial markets that we have. So the first thing is, I think COVID is going to accelerate the attention of governments. Investors, as they use this information, are going to be complaining to the regulator that the information disclosed by companies is very uneven and sometimes misleading, and the regulators are going to have to get involved. So it's inevitable that it's going to happen. It depends how many investment organizations begin to complain, frankly, for regulators to begin to step in. Now, to the second part of the question. As George pointed out, we have a very unfair corporate taxation system. In effect, companies are pursuing profit and creating huge environmental and social damage in their wake, and then government is having to tax everyone, including every one of us as individuals, in order to remedy the damage caused. What audited transparency on impact is going to do is it's going to enable government to focus on the companies shown in our 1,800 company data set that are delivering $200 billion of environmental damage in a single year. And the 250 which are delivering more environmental damage in monetary terms than they are profit. And the third of the companies, the 600, that are delivering environmental damage that is equivalent to a quarter of their profit or more. These are massive numbers. It's going to allow government to tax these companies directly. And we may shift to an accounting for taxation that allows positive impact to be deducted from profit when you get taxed. And if it's negative impact, it gets added to your profit and you get taxed on it. So we're bringing a massive new tool for government to incentivize companies and investors at a time when governments are going to have very little money because of the huge national debt they've had to take on as a result of COVID, and a huge increase in social issues that arise from high unemployment, greater poverty, greater homelessness, and everything else that flows from sustained high unemployment. So I think the forces are already there in place for government to get involved, but we have to raise our voices as investors, as consumers, and as employees to push for this transparency. It is the new human right. Transparency is the new human right. We have the right to know.
That's great. George, did you want to follow on to that? Oh.
Rob, if I can just join for just 10 seconds to say something on that, because this is a very important point. Taxation without representation, as we know, led to a huge revolution. And I think right now we have a system where it's taxation without accountability in many ways. And the reason that this is happening is because, for example, you might have some companies that might be taking advantage of labor, and as a result might be paying below living wages. They might have a terrible workplace environment where mental stress, mental health issues and stress might be the norm, incivility inside the organization, leading to huge costs. But at the same time, the way that the system works is that Francesca and you and I actually pay for many of those costs. Why shouldn't directly a company that creates those negative externalities pay for those costs in the same way that they might be emitting carbon emissions or other pollutants, or their products might be actually contributing to diabetes and obesity, and why we shouldn't have actually government action and a policy making framework that incentivizes for companies to create positive impacts. This is what businesses actually, many businesses that are actually leading the world for a more sustainable, for example, environment and society, are asking for regulators to provide incentives for their products to be more competitive, and as a result create a race to innovation, not a race to the bottom, but actually a race to innovation. So this issue is an incredibly important issue. And from my perspective, I see a tremendous actually incentive for governments and for regulators and for policymakers to lead in that effort. It's going to create an enormous value from their perspective as well, new forms of revenues for them, and eliminate many costs that now we know how indebted governments are not able to actually provide the needed services for their citizens.
Mm-hmm. That's really fantastic. George, the next question is for you as a follow-on to that. One of the questions that we've gotten on some of the research that's been out there and mentioned is, shouldn't suppliers' impact be included and not just impact on employees? Somebody stated that Apple's made a lot of progress on their employment practices, but there are still things happening down their supply chain which may, are not reaching the level that we would hope. So there's that question, and then whether broader social impacts would also be included.
Yes, and it's a terrific question. And for me, all those questions are scoping questions in terms of the scope of the measurement. And there, what I would say is that we're trying to go through the whole value chain, but we have started from the operational impact that you're having inside your operations. But the employment framework, for example, has some labor community impacts. For example, it has a diversity impact and it has also a location impact. And both of those are labor community impacts. They are not directly on your own employees. So we are moving the scoping to incorporate also some of those other effects. And on the product impact side, of course, we're moving from, the way to think about it is from a downstream scope 3 measurement perspective, not only on the environmental side, but also on the social side. And when we have made progress there, we'll move backwards as well, and we will be able to capture some of those supply chain effects. But I would ask for, I guess, a little bit of patience as we're moving through all of those things. Nothing is easy here. Everything is difficult. And I think adopting the scoping perspective where you can understand all the scope questions that might exist in terms of upstream versus downstream versus operational effects is an incredibly important one.
Fantastic. Quyen, do you have a minute to answer some questions or so?
Yes, Rob.
There's lots. Okay.
Yep, happy to.
Perfect. Okay. So one of the questions is for you on a post of remarks, the private sector has been a force that can set standards from the dignity of work to push an innovation. But why is it so difficult to bring the private sector to invest in social development? People often say that they see the money going to PR or marketing when there's so much to do on social to mitigate conflict.
Yeah, I think the reasons can vary region by region, but I think what is most common among this barrier, this resistance, is likely two issues. One, the lack of data and transparency, so the lack of awareness of what we don't see. So I think that's primary. And two, I think there's a myth still that investments such as in social development, environmental mitigation, environmental impact, there's a myth that these types of investments must be concessionary. You have to give up returns, and that's difficult for a lot of organizations, understandably. And so to bust that myth, which we think is a valid one. The busting of the myth is a valid one, not the myth itself. You don't have to give it returns. I think that's important. It relates to the value proposition behind what impact investing is doing. So if we were to just step back and think for a moment about impact investing, much of impact investing is about investing in the solutions for, unfortunately, the extraordinary demand for solutions for unmet needs, spanning, all those themes that I mentioned earlier, affordable housing, access to finance, access to credit, basic education, clean water and sanitation, as well as products and services that help protect our environment and planet. There's such great needs and there's such great problems that there is a lack of supply to meet that increasing demand. And so from a structural growth perspective, there's a huge opportunity here. There's a huge structural growth story and profitability that you don't have to necessarily give up returns. So that supply demand imbalance, I don't think is going to go anyway soon, unfortunately. But that myth that you must give up returns, I think is a huge barrier, either from a fiduciary perspective or just from a misunderstanding. Now, there are important roles for different types of impact investing. The concessionary impact investing approach is critical, but also it's not the only one. There's a whole spectrum that's available. So I think the myth of concessionary returns, the necessary giving up of returns, as well as the lack of transparency and awareness, are the two key barriers.
Yeah, that's perfect. And to add on to that, Lori Spangler just put in a note in which I wholeheartedly agree with, saying return expectations need to be reframed. Current trade-off formulations are undervaluing positive impact and ignoring negative impact. So this transparency, what you talked about earlier, should lead to a negative playing field. So Thank you so much, Quyen. Ronnie, I guess the one political last question for you, there's a question about how do we deal with greenwashing sort of in the space, and how does this sort of the development of accounting and bringing auditors in, right, into the fold, and developing this into sort of a codified science, right, in a way, the same way that accounting has developed, help us to alleviate that challenge.
So greenwashing is a major problem now, as many of us are directly aware. I think there are over 60 or 70 investment firms on this webinar. And the only way to deal with it, Rob, is through transparency on all the aspects of impact. Let me explain. If all you focus on is environmental impact, then companies will argue, yep, we may be delivering terrible environmental impact through our operations, but look at all the great unmeasured employment and product impact that we deliver. So if we want to be able to deal with greenwashing, we have to get to transparency. Now, why is greenwashing today helping us get to transparency? Because it's turning out to be price sensitive. And so companies putting out marketing statements that can affect their share price on the basis of misleading information is a real problem for regulators. So we have, if we want to stop greenwashing or any other type of impact washing, we have to go for transparency. And this relates to a very important theme, which I've seen running through the questions around ESG and so on. We should not today be pushing for simply reporting disclosure on tons of carbon and other metrics, because that will not change the behavior of companies. Of course, the EU and others are about to pass legislation on that, and we should totally encourage that. But we should at the same time make it clear that this reporting has to be complemented by financial accounting, reporting through financial statement, because that is what is going to get the $30 trillion that is already flowing to create impact to hit its destination, to fund the companies that really are delivering positive impact and bringing solutions to the big social and environmental challenges we face.
That's a great answer. I think it really addresses the question. On the back of that, George, somebody raised a question. I think you have some slides to talk about this, but there's the question of most executives are focused on growing their business in a hyper-competitive environment, right? And there may not be an incentive to really do this or really focus on sustainability unless investors start asking about it. So I guess the question to you is, A, how does this actually help in terms of being a management tool? And then how do we move that agenda up for investors?
Thank you, Rob, for this question. And let me actually share some slides in answering that and connecting also to the previous question around good washing. And I like to call it good washing because greenwashing is a particular aspect of it around the environment, but it's in general about the impact. I like to call it good washing. And I just want to draw this distinction between inputs and outcomes. That a lot of what we have been measuring, a lot of what we have built in the ESG marketplace, because that's the data that we had, was about inputs, policies and principles and disclosures and management systems that have some intention to drive some types of outcomes. But in many ways, we haven't seen those outcomes materializing. I call this the deforestation problem. Every consumer packaged good company now has deforestation policy, but actually the forest is disappearing. Every now large company has a diversity policy, but organizations haven't really become more inclusive. And this is what we find as well. This is from our application of the employment impact framework. And these are the numbers in terms of employment impact as a percentage of EBITDA for 4 leading organizations. And under that, the raw employment impact number that we're finding for them, for example, for Costco, we have estimated that to be a little bit about 9.6 billion. Costco is well known among its industry peers to have good employment practices, and this is manifested in the numbers. But something that you will see in the paper as well is that those numbers are lower than the total amount of wages that those organizations have paid. Why is that? Because actually many of those organizations are still not diverse. And not only that, but actually the opportunities that are being provided across gender, across racial minorities are not equitable. So you're not observing promotion rates, for example, happening in an equitable way across racial minorities and across men and women inside the organizations. So what this means is that many of those inputs in terms of policies, for example, they don't translate into outcomes. That's why we have fundamentally a not level playing field across races or across gender in society. And I just want to show also this picture, which is where we want to go. Where we want to go is that impact is reflected in market prices in a systematic way, and that firms that deliver more positive impact are actually trading at higher multiples because they have lower cost of capital and because they're estimated to have future growth opportunities that are higher. And some of that is already happening, as we mentioned before, for example, in the environmental space. This is the estimate of how much of a discount a company with double the environmental intensity relative to its peers will be trading off. So for example, if you look at beverages, that would be about 10% of a discount if you have double the environmental intensity relative to some of your competitors. And what you see here is that this is not happening in all industries. And we actually know that this is definitely not happening in some of the other dimensions of impact, like employment impact or product impact, where for a long time, there has been no transparency relative to the environmental impact. So the work that we're doing is incredibly important. We have to move all markets towards the left-hand side of this chart and away from the right-hand side, where actually impact is not reflected into market prices. And as a result, Rob, to your question about incentives for the management, those incentives need to be created. Those incentives need to be created, but because if impact is reflected in the market prices, then executives and boards will have incentives to actually improve that impact dimensions because of the compensation structures that are heavily tilted towards share-based compensation, stock-based compensation, and so forth. So this is something that is incredibly important. We're not there yet, and we need to build an outcomes-based infrastructure in order to have management systems that gear towards that optimization of impact in an economy that optimizes risk, return, and impact.
Thank you very much, all of you. So we're coming now to the end of this webinar, and we think it's really clear that we've covered a really large number of themes and topics. We've had a huge number of questions coming through the chat box to the panelists and through the Q&A. So some of the things we heard today from Ronnie is impact transparency and human rights, the need for governments to incentivize companies to have impact and to pay the price for the damage they cause, George, and we've heard from Quyen about the myth, the damage of the myth that these types of investments that consider social and environmental impact must be concessionary, the damage that myth causes, and the damage of good washing. We've covered a great number of topics. We've now come to the top of the hour, so just a few things before you leave. We have an initiative running through November where interested corporates and investors can be invited to deep dive on this topic to hear more about the environmental pillar, the product pillar, and the employment. A lot of organizations have already signed up, but you'll find the link to express your interest in joining them in the chat box. Laura will put that in shortly. And we have also, it would be great. We had a number of questions from you about how you can implement this within your organization or how you can get others to. So the answer to that question is you can get in touch with me or with the IWAI team, and all the contact details will be in the form in the email that will be sent shortly, and you can express interest that way. So thank you all. It's been a really inspiring and engaging discussion for me and hopefully for all of you. Really big thank you to George and Ronnie, Quyen and Rob for participating, and really for all of you for your really thoughtful and challenging questions on this really important topic. Thank you for your time, and we really look forward to reading your comments and seeing you on the next GSG webinar soon. Thank you very much.
Thank you, Francesca. Well done.